Good morning, everybody, and thank you, Martin, for that introduction. I'll try and live up to it. And thank you to the ICMA for inviting me here to Dublin to speak to you. And so I'm going to talk about regulation, which is never the most fascinating topic in the first place. And given the night last night and the band playing and everything else, I'm just grateful there's someone here to listen. So in the immediate aftermath of the financial crisis, in 2008-9, and certainly by 2009 when I joined the European Parliament, regulators and policymakers had gone into overdrive. This is because although there were many different causes on the crisis, many different contributors, diverse causes, as many PhD theses now tell us, and commentaries all attest that this was a complicated time. But the behaviour of regulators was definitely part of the mix. And a light-touch regulation, a principle-based approach, the lack of enforcement mechanisms and mandates to encourage the growth of the financial services sector all have been cited as contributing factors to the excesses that took place prior to the crisis. So it's therefore unsurprising that in the immediate aftermath of that, different jurisdictions looked at reforming their financial supervisors as well as the regulatory framework that they were operating within. So to put it really plainly, the regulatory system went into overdrive because so many were accused of having been asleep at the wheel in 2008 and before. So every politician, every regulator, supervisor, central banker all saw it as their responsibility to spot and prevent the next financial crisis. And no regulator was ever going to get into trouble for calling for higher capital requirements. Certainly no supervisor was going to be called into question if they imposed a draconian fine upon a large institution who'd done wrong, and no politician was going to be voted out of office if they actually called for a clampdown on bankers' bonuses. So this was the backdrop that we entered into when we developed and got through the Parliament over 40 pieces of regulation that had been negotiated in that 5-6 years. It's also why ESMA, IOPA and the EBA were established in 2010. The regulation and restructuring all were aimed at facing up to the past mistakes and ensuring that there were no regulatory gaps for the next crisis to emerge from. It meant that duplication and overly burdensome administrative costs that were considered at the time a small price to pay for a more stable financial system. So stability, resilience and systemic risk were the buzzwords across the financial markets and the financial capitals, including Brussels, during this time. And they genuinely thought that this was something that they actually had to ensure. So all three of these are important and essential for a fully functioning financial system. However, I think at some point we did lose sight of what the financial system is also supposed to do. It's supposed to finance the economy. It's supposed to manage risk, and it's supposed to produce jobs and growth ultimately. So how do we match these businesses who are prepared to take risk with those in finance who are prepared to take the financial risk in funding it? So I think in the financial crisis, the regulatory zeal of the following years, it was economic growth that suffered the most. And I think we're now starting to see that. We've actually succeeded in preventing the entire financial system collapsing, but we also now, as politicians and policymakers, know that we now need to get the system up and running again, financing a growing economy for the future of Europe and beyond. So at an EU level, it's why Jean-Claude Juncker and Lord Hill in particular have placed Capital Markets Union at the heart of this growth strategy. And I know you've already heard yesterday a lot about that from other speakers, and so I'm not going to go into any major detail on the CMU. But needless to say that the Capital Markets Union is the forward-looking agenda, which I hope is going to reap benefits of the single market within the EU for financial services, for companies across the breadth and depth of the EU. And so we're actually going to have a truly single market going forwards. But even before the building blocks of CMU are put on the table, the Parliament have been calling for a cumulative impact assessment of the past 5 years' regulation. We need to know what has been the effect of the multiple capital requirements directives and regulations on the ability of banks to fund businesses? Did all those complaints from banks about the specific rules on beneficial activities like trade financing and the market securitization actually really happen? Are they a real effect? Is there data to support the fact they have been badly hit? What behaviour has been encouraged or suppressed by the interactions between the market regulations and the prudential regulations? And more fundamentally, I think in our haste to fix things, did we perhaps overreach in certain areas? And did sometimes the outcome not match the original expectation? So I'm actually proud to be part of the EU institutions and give full credit to the Commission that one of the first acts of the newly incorporated DG FISMA was to launch the call for evidence on the cumulative impact of financial services regulation. And for the European Commission to commit themselves to changing things that are demonstrated to have been bad for the market. And I think this actually contrasts very significantly with the way that the US Dodd-Frank Act is unable to be changed. We're not stuck in Europe at this point in time in a political deadlock that means we can't work together to achieve the common objective of ensuring that the primary regulation itself is fit for purpose. The EU has multiple methods and mechanisms for fixing things when they don't work. And the first one that we need to actually recognise is that every piece of legislation since 2009 has had an inbuilt review directly in the Level 1 text. We don't have to rely upon an expose in the newspapers or trade bodies going into overdrive. It's a routine tool. It's there, the timing is known. So typically 3 years after the implementation, the Commission or indeed ICMA are called upon to specifically review certain aspects of how the regulation has functioned or to provide a report on the regulation's impact as a whole. And this is currently, as many of you will know, being done on EMIR. Even though the clearing obligations have not yet been implemented, there are many other aspects of EMIR that have been in place for a few years, and we know that many of them need some fine-tuning. And we expect a report from the Commission on where they think the legislation should be changed very shortly. And then that will be followed by a legislative proposal, we hope, by the summer. So the review is the first method of correction. So the second method of correction is what we're referring to within the EU institutions as the quick fix. Now, I'm always surprised by how often this method is used for solving blatant omissions or mistakes that we've made in the legislation. And they're often being identified within the new system by ICMA as part of their Level 2 rulemaking process. Or the alternative route that we get many alerts from is the national regulators. And sometimes the market participants themselves bring us the data that show that certain pieces of the legislation are unworkable and therefore need to have some quick fixes. Now, the 3 changes that were agreed between the Parliament and Council in MiFID II last week are an example of this. When MiFID II was passed nearly 18 months ago, it was only when the full extent of the Level 2 was extrapolated by ICMA that we knew how hard some of the IT resource intensity was going to be. We knew that some of those deadlines were not going to be achieved. So the supervisors and market participants have got enormous IT resources that they need to commit. And the timelines we laid out in the original legislation actually were laid bare and declared unworkable by ICMA and others. So instead of simply telling the supervisors and the market to get on with it and risk having a failed and costly implementation by keeping to the original schedule, the Commission recognised that it was impossible and brought forward legislation that would postpone the adoption by a year. This provided the Parliament and the Council, as co-legislators, with an opportunity to fix a small number of other issues that had been identified prior to the regulation taking place. So instead of waiting for the damage to be done and to fix things in 3 years' time, we've taken the bold and unusual step of admitting some of our mistakes and acting now to correct them. So on the Parliament side, we worked together across all the active political groups to jointly draft and table amendments on those specific issues that we had full agreement on. So we reached full political agreement within the European Parliament, within that negotiating team that had done MiFID I, in record time. So to put this into context, when MiFID II was first proposed by the Commission in 2011, there were 2,145 amendments from the members of the Econ Committee submitted. For the quick fix, we ended up only with 5. All of them were co-signed, all of them were pre-agreed. After the Parliament had done this, we then met with the Commission and the Council for a single trialogue session to agree exactly how to solve the issues on the table. And for those of you who know the EU legislative process, you'll know how long and painful it usually is to get that level of agreement. But in this case, we were able to address the issues raised by corporates accidentally caught, for example, in the anti-HFT provision, and to come up with a solution. We were able to identify and solve the issue raised by ICMA and multiple market participants of the asymmetric transparency provisions for packaged products that would have caused a huge discrepancy between the US and the EU requirements, particularly on derivative products. And importantly, we were able to remove the uncertainty about how MiFID would be applied to the securities financing transactions, which would have prevented, I hope we've prevented, the huge interpretation discrepancies between different competent authorities in the EU. So the errors were identified and we fixed them, whilst we've lengthened the time period for MiFID II to come into force. So I'm going to refer to the final method that we have for correcting things and improving the regulation. And that particular process is arm's length to the politicians. So I've actually struggled to find an example of when it's been used. The method I'm talking about was put in place when we designed ESMA, the EBA and IOPA, in answer to those who'd actually told us that the EU legislative process was too slow and cumbersome to respond to any market developments. So when we set them up, we gave them, those supervisory agencies, all 3 of them, the power to rescind and adopt new regulatory technical standards as they saw fit. They still have to be accepted or rejected by the Parliament and Council, but it's a process that could be done in 3 months. Faster if they choose to pick up the phone and actually have a dialogue with us to make sure that they secure a non-objection. The detailed Level 2 rules written by ESMA are often based on a broad legislative mandate that they're able to interpret and implement with a degree of freedom to find the most efficient way of achieving what the co-legislators had asked for. For example, they were asked to write detailed rules on reporting of derivative trades. The level of granularity that they saw as appropriate to the market in 2011 may, of course, have changed since then. There may have been more international convergence over the best way to aggregate data. New data standards may have been agreed by industry within that time too. So ESMA technically is able to reissue those standards to reflect such changes. And I would argue that not only should they think about it, they are duty bound to do so. So we can extend this to many of the provisions in those Level 2 rules that were spawned in the 40 pieces plus of EU legislation. And I'd like to return to the call for evidence by the Commission and actually make clear this is not a PR exercise. It has full political support across the European Parliament and the majority of the Council. And if you can identify where things have gone wrong and find ways of fixing it, then we need to actually hear from the industry. And to be clear, some of the painful consequences of the regulation were intentional. You may not like them, but they were planned and intended as a result of the behaviour that was seen in the financial markets in 2007 and 2008. And actually, some of those behaviours are designed to be changed to suit a more modern, efficient and resilient financial system. But the genuine unintended consequences can and will be fixed if you provide the evidence and data to support a change. Now, if any of you were actually listening to the call for evidence hearing this week, you'll actually have heard me be reprimanded by one of our German Green MEPs, who actually said I was being far too British and I was a British empiricist, calling for evidence and data to justify changes. Now, I don't apologise to him, and I'm certainly not apologising for being that person who's a scientist turned banker turned politician. And I actually believe that the only way we are actually going to get to the bottom of regenerating growth across the European Union is to actually make sure that the financial services sector is working efficiently. I do believe we need to fix those mistakes when we identify them, and the only way we can do that is through data. Now, your industry across all the different sectors is run on statistical models, analysis, and data. I fully believe that you as an industry are up to the challenge of providing the evidence that makes the financial system more resilient and stable while still being fit for purpose. More efficient markets, establishing best practice, and achieving well-regulated markets are in everyone's interests. And as we move forwards to a more effective capital markets union across Europe, identifying the good and bad in our policy decisions becomes even more important. Thank you for listening, and I don't know what time I've got, but if there are any quick questions, I'm more than happy to take them from the audience. Thank you.
Good morning, it's Alex Merriman from Six Security Services. Kay, thank you very much for that exposition. I wonder whether you might be able to say a word or two in terms also of sort of the forward-looking post-trading agenda. We've got the EMEA review, which we'll see the results of soon, I hope. CSDR is due for review next year as well. But I just wondered how Econ is able to monitor and follow the work of the Commission's post-trading forum, which of course is due to report by the end of this year, and I wonder how you're able to influence that work. Thank you.
As many of you will know, the European Parliament does not have the same legislative agenda as it had in the previous mandate. And that's because the Commission's structure has been reformed, and the better regulation agenda of Jean-Claude Juncker is actually trying to get the amount of legislation down to 20% of the previous mandate. So that's not reducing by 20%, it's 20% of the previous mandate. So it's a complete sea change in the way that we're doing things, which means the Parliament and all the negotiating teams have now got time to actually monitor what's going on the existing legislation that's there and how it's being implemented across the different member states. So we're holding negotiating team meetings with ESMA and the Commission on a regular basis across all the files. And where there's a review due, we're not waiting for the Commission to produce documents, we're informing them throughout the year of issues that are arising. So I would encourage all of you to interact with the members of Parliament on the negotiating teams. Even if you think that they're not doing anything, I think it's one of those things that below the surface we're all working fairly frantically. So we are monitoring every set of level 2 rules. When they get fractious and there are disagreements with ESMA and Commission in private, we do a hearing within the committee, and so you'll find some of the more contentious issues being raised. But ultimately, we have a system now where we are spending more time on the level 2 rules and scrutiny and the potential review periods coming up than we are on fundamental new legislation. So on that basis, I think you'll find that the committee is fully engaged in the process, and we're open to having data and evidence given to us and suggestions as to how things might work better. Because during all of those review processes, I think we all feel it's beholden on us to find ways of making it more efficient rather than actually just putting an increased administrative burden on the market participants. So we are trying our hardest to work in a much different way, and certainly the better regulation agenda is one that most of us have bought into. It's very dark out there, I can't actually see, so... The front row. There's light now.
Thank you very much for your exposition. It was very interesting. Can you perhaps, as a follow-up to what you were just saying, tell us if there's any thinking in the committee about how Europe is left to deal with weak banking systems, with the combination of EU state rules, the BRRD having come into force? Certainly there's a sense that including in the policymaking community, people are realizing, oh wow, maybe we went too far and now we sort of don't really have tools to deal with the problems at hand. Is the Parliament at all thinking about this issue?
We certainly are. One of the big things that we have realised is that we all have worked during this last 7 years in silos. And the Commission have worked in silos. The different units have not talked to each other. The Parliament's negotiating teams have worked in silos and don't necessarily talk to each other. Some of us sit across the different dossiers and provide some consistency. But that silo way of working over the last 7 years has led to a lot of mismatches between different files. And I think the call for evidence now is focusing very much on where, in particular, markets-based regulation is clashing with the banking regulation and the prudential standards. So we didn't pay enough attention, and myself included and others in the MiFID negotiating team didn't pay enough attention to the crossover to CRD. So when we extended the scope of an investment firm, we actually didn't look across to the capital requirements directive and regulation. And so these are things we need to fix. They're things the Commissioner is convinced he has to fix. And I think we now need to actually work on what would be a proportionate regime for other players who are non-banks within that space under capital requirements. So we are working hard on it. I'm not sure we yet have had any sensible proposals from people as to what would work. And I think we need to actually start encouraging people to bring forward alternatives. Rather than say we're outside of scope, I think coming forwards with proposals is going to be a much better way of dealing with this. But ultimately, that lack of crossover, the silo thinking, has been a huge problem. Recognising it is the first step, fixing it is going to be the next one. But we definitely need to do it, and Lord Hill is committed to making sure he tries to iron these out. Some of them are really quite glaringly bad. But I think maybe if we take one more, and then I'm going to hand over to the experts on the panel instead of having to listen to me. I think it's... In that case, I'm going to leave you to the panel. Thank you very much for listening.